Good day. This is another Hump Day Real Estate with Kendell. And I have who I have with me today again.
Laura. Laura.fournier with Nations Lending.
Laura, how are you doing today?
I am having a fabulous day and week. Another good day. Sun is shining and it's warm outside.
Very warm, very warm. Well, we're going to talk today a little, help some first-time home buyers and in some instances not first-time home buyers, because I believe there are also grant programs and down payment assistance for some non-first home buyers. So
yes, the phrase first-time home buyer is kind of a bit of a catch-all phrase, and it really is mostly referring to loans that have small down payments, either no down payment in the case of a USDA loan, or Fannie Mae has 3% down for first-time home buyers, and FHA, the original first-time home buyer program, is 3.5% down. But you actually don't have to be a first-time home buyer. You just in some of those cases cannot own another property when you close on the property that you would use these down payment assistance programs with. But you can actually, in a lot of the cases, have owned a house before, or even immediately before, because you could sell in the morning and buy in the afternoon.
Gotcha. So one of the big programs that's been spoken about out there a little bit here lately, I'm hearing a lot of folks talk about is the MMP. What is that, MMP?
MMP is Maryland Mortgage Program. So, and that is a very good program, available in all of Maryland, and it covers the whole entire state. They don't seem to ever run out of money. They haven't run out of money for years. Now, if they have a specialty program just for like a particular county that they pop up once in a while, that is a limited chunk of money. But other than that, the regular MMP products are available all year, year in, year out, and they're funded by the state of Maryland, and they don't run out of funds. So it's always available.
Gotcha. Are there any key points that folks should know about the Maryland Mortgage Program?
Yeah, they have what they call a dual track, and they have, I think, about 6 products that are for first-time home buyers. They call them their first-time advantage product. And then they have their Maryland Mortgage Program MMP Flex, and that is for somebody that has owned a home before. So, and they have loans that fall under that category. So they have the big umbrella of the MMP, and then they have different products underneath that umbrella that offer loans to buyers to use for their down payment. And then they have a couple that give more money than you just need for your down payment. So you can get your down payment 100% covered. So if you're doing conventional, you would get 3% for your down payment. So basically it's a no down payment loan, because the buyer themselves doesn't have to have their own money. They can use this MMP money, and then you can get 1% or 2% above that to go towards your closing costs. So it can actually reduce your total out of pocket on the loan by that percentage amount. And in general, closing costs run 4 to 4.5% of the sales price. And so you could get into a house for maybe 2.5% of the sales price if you use this program. So it really, really reduces the out-of-pocket costs for the new home buyer.
Gotcha, gotcha. So I think you answered the question I was about to ask, was what makes MMP loan different from other loans? And I think you kind of chimed into that a little
Yeah,
bit.
I'll expand on that a little bit because there's other programs, like DC has a program called DC Open Doors, but they only give you the down payment. They're not giving you that extra amount that would cover closing costs as well. So Maryland's gone that next step to not only just cover that down payment in its entirety, 100% of down payment, but they're going to give you a nice chunk towards your closing costs. So that's really going to help boost buyers in Maryland to get them in. So if they've just saved a little bit of money, because if you're buying 300,000, 1% would be $3,000. So if you've saved, you know, say 6,000 to 7,500, you probably have enough plus the Maryland mortgage program to get you into a house with that, some of your own money, and then the Maryland mortgage program money.
Gotcha, gotcha. So if folks are out there and they're looking into the down payment assistance, what's the difference between MMP and they hear a grant? Is there any difference there?
Yeah, the Maryland mortgage program used to offer a grant and they do not. They took that away about 6 weeks ago, 2 months ago. So the grant was like a gift. So just think grant equals gift. So they gave you the money, the grant money, and you were not obligated to pay that back. So if you got $7,500 at settlement from MMP, you were done. You didn't owe them any money. Now with the loan, they're giving you a loan and it's at 0% interest and there's no payment on it. But eventually you're going to pay that back. You would pay it back either at the end of the term of your loan, say 30 years, or you go to sell the property, you would have to pay it back, even if that's 5 years from now. Or if you refinance, you would have to pay MMP back. So a loan is not a gift. They want that money back. Now, they didn't charge you any interest on it, so to speak. They didn't make you make any payments, but they want their money back. So, so at the end of, say you're moving, you're going to move up to your next house at settlement, you're going to pay off your balance on your first loan, plus you're going to pay back the money that you got from MMP.
Gotcha, gotcha, gotcha. Now, some of the, I know some lenders in Baltimore City or some grants you can match. Are there any matching that can be done with Maryland Mortgage Program?
They have the partner match program. So if your company is an affiliate, the company can affiliate with the Maryland Mortgage Program. And say your company says, I'm going to affiliate with the Maryland Mortgage Program to help any of my employees that can use that program with their house purchase. And we're going to give $1,000 to our employee when they're buying a house. So then they would sign up with Maryland Mortgage Program. It's not that much paperwork for an employer to sign up. And, you know, it can be a big company, a little company, but they would have to offer this to every employee. And then when you did the Maryland Mortgage Program, you would get the 5%, so 3 towards your down payment. You would get 2 towards your closing costs, and then you would have the partner match. So your company would give you $1,000, and then Maryland would match that 1,000. So you would get an extra $2,000 towards your closing costs.
Wow, okay. Okay.
So there's some of the school systems were signed up, but then they didn't fund it. So they were on the list, but then they didn't really have any money for it. And I know there's been some other employees. So basically I have the buyer call their HR department and ask. We can look it up if it's on the list, but if I see it on the list, I have them call their HR department to make sure they have funding for that partner match program.
Do we know how that funding works? Could it be a nonprofit organization that gives money to the school system or what have you?
I believe it can be.
Okay.
That they can have nonprofits can participate with that as well.
Gotcha. Okay.
Yes.
What else you have for us in regards to MMP or grants?
MMP has a Home Smart program, and that's for borrowers that are at low income, and they have they're at 50% of the area median income, and that's something we look up by county.
Mhm.
And if they're at that, then they get a loan equal to 6% of, so they get an extra percentage towards
Mhm.
their closing costs.
Gotcha.
So that's a special little program. They do have two other programs that our company does not participate in because you have to be at a gold level. So it's usually some of the bigger banks and stuff. They have Maryland Smart Buy, which helps you with student loans. You can get some of your student loans paid off. That's a little bit tricky. I do know about it. The balance is 30,000. So if you had 30,000 or less, you could get that basically paid for, but
Mhm.
it has to cover all your student loans. So say you had 40,000 in student loans, you would have to pay that difference of 10,000 to use that program. That's why it gets a little messy. I don't know why they actually worked it up that way.
Yeah, I was looking into that program. It was like, what are you guys talking about? If
Yeah,
somebody,
it hasn't worked for too many people. And then they made it exclusive to certain lenders, and then that made it even more messy. I haven't actually had a client use it just because they didn't fit into that little bucket that they have.
well, the first thing is if I'm looking for down payment assistance, and I have 50 or $100,000 in student debt, where am I getting money from to pay a percentage of that student debt off in order for it to participate in that program? So it's like,
Yeah, and I don't know if it makes sense if like a lot of people have income-based repayments on their student loans, or their interest rates are lower than, so sometimes it just doesn't make financial sense, but that is there, and I do get asked about it from time to time, but it doesn't really hasn't made good sense for any of the buyers that I've discussed it with. So,
yeah.
but it is in general a good program. They've really cleaned up the processing of that program. It used to be really messy, like just horrible, but they've really done a good job. So we're doing those loans. It's because it's two underwritings. As a lender, we underwrite the loan and have to fully approve it. Then we send it to the Maryland Mortgage Program and they have to approve it. And then paperwork goes back and forth. And we make them all happy, and then we can close the loan. But we are doing it in 30 days. So
and that process is the same even if you're dealing with grants, correct? If you guys do your underwriting, and then there's things that has to be done for grants as well, correct?
Yes. Yeah, it works pretty much the same. The internal paperwork is more for the loans than the grants, but yes, the loan still has to be underwritten by Maryland Mortgage Program. And when the market was super hot, that made it a little more difficult because a lot of sellers didn't like the fact that the loan was going to have extra scrutiny and could get messed up on that end.
Oh, that and 45 to 60 days, most lenders were saying put on the contract. So
yeah, luckily we were still getting them through in 30 days.
Good thing.
So very sharp with that. And the rep there at Maryland Mortgage Program, she's very good, very helpful. And so we've had good success with those loans. I do recommend, because they have a 3% loan, a 4% loan, and a 5% loan. But if you're going to use it, just use it and grab the whole 5%. And, even if you have some of your own money, keep that money because you're going to have expenses for the move. You might need a lawnmower. You need things when you buy a house. And you need a little money in the bank because, you know, the hot water heater could need a new something.
Anything can happen.
Something can happen, and you need some dollars sitting there for that rainy day fund, the fix me up fund.
Yep.
So,
Yep.
but I think it's a good program to use for home buyers. And, you know, if somebody has all of their own money, I recommend that they use their own money, because the pricing, the rate is different on the Maryland mortgage program. That program sets the rate, so it's not a market interest rate. And I do show that to my buyers. I show them what they'll pay if they use their own money, what they'll pay if they use Maryland mortgage program, just so that they know it's educational, and then they get to decide. But if you have 20% of the sales price in your, and as assets, not retirement, but then they have an asset test. So sometimes if you have your own money, you can't use their program, but that doesn't happen very often either.
But one of the things I'm gonna throw out there that I think that home buyers should maybe look into as well, if they have some money, or they have, even if they have all the money, but they still qualify for the 5% down program. What else are you invested in out there? So does it give you an opportunity to now purchase a home and then now take this other money and get an ETF or something to start your investing journey? So
yeah, that's a great point. Very good point. And also, if the house needed a little bit of update, use the Maryland mortgage program, and then use your money for sprucing up the house, and then you're building equity in your house as well. So yeah, and the one thing that I did not say, but I want to make sure it's clear, is you have to income qualify for the Maryland mortgage program, meaning that if you make more than their income limit, then you're not eligible. And that is by county, so I'm not going to throw out numbers out there, but it's by county. You can look up the Maryland mortgage program. You can just type that out in Google, or you can put in MMP and it comes up as well. But you can see the rates, you can see the income eligibility charts and that sort of thing, but it's by every county. But most people are going to qualify because they really up the numbers. So they're in some areas, well over 100,000. So a lot more people are going to qualify for that program than even just last year. So that's one thing. And the credit score, always got to talk about credit when you talk about a mortgage, because 640 is the minimum credit score that they will work with. So if somebody's credit score is below 640, then I will help them with a credit repair and get them above 640 so that they can use the program.
Gotcha. So what are you thinking? We're going to switch just a little bit, unless you have some more that you wanted to talk about on the MMP or the grants.
No, I think that pretty much covers it without getting it too confusing, but it's a great program, pretty easy to use if you have a lender that does it enough like we do. And I think it's a good way for buyers to get into their first house.
So I have something here that I'm taking a look at. And it says, should a buyer buy a home with inflation being this high? And I'm going to read out what this says, and we'll see how you feel about what they say. While the Federal Reserve is working hard to bring down inflation, the latest data shows the inflation rate is still going up. No doubt, filling the pinch on the wallet at the gas pump or the grocery store, but the news may also leave you wondering, should I buy a home right now? Well, this person, Chief Financial Analyst Greg McBride says inflation will have a strong influence on where mortgage rates go in the months ahead. Whenever inflation finally starts to ease, so will mortgage rate, but even then, home prices are still subject to demand and very tight supply. That statement, how you feel about what he's saying there?
Well, we know that less than 2 years ago, inflation was at 1.4%, And now the latest inflation number came in at 9.1%. So whatever that is, 6 times.
Yep.
So that's a big, huge jump and increase. And we do know that housing prices are up, but maybe they've stabilized. But interest rates are definitely up, not quite double, but they're up a couple percentage points. So the house payment will be more. But I'm going to, since I lived through times when rates were double digits, they were, I didn't buy a house during Jimmy Carter's reign, but they were in the 18s, 15 to 18%. But I did buy my first house at 11% interest rate on a 30-year fixed. And I was still glad to be a homeowner. And I think as long as you know how you spend your money and areas that you can pull back when you need to, and you can afford the payment and it's not tight, we don't want to like max you out, then buy now, because rates for the most part are, in the 5 range, and that is still historically low. I've said this before, a 300-year average is over 6.65. So rates in this, where we are now, is still very low. Still very low. So, we brought up in a conversation that you and I were having about rents.
Yep.
Rents have spiked faster and gone up faster than ever before in the history of them tracking rents. So not buying is not a stabilizing factor to your budget. And for most people, their house payment, whether it's something they're renting or something they own, is their biggest expenditure every month.
Yep.
So fixing that in a rate, something in the 5s or at 6, low 6s, and having that fixed and knowing that that's your payment can be very stabilizing to your budget, because you know what your target is every month. And hopefully you have some reserves to carry you through, especially if you are a person that has some variation in your income. Maybe you don't work the same number of hours, or maybe you're self-employed, maybe you're commission. So I think I'm still one for purchasing when you can afford to purchase, even when there's some inflationary times. And I know that all of us in our spending habits, we buy things that we don't have to buy. There's things that we can cut out that we spend money on, and we're not going to be suffering. So if, things do get tight because, you have to put more money into your gasoline purchase bucket, then you trim back on, I don't want to pick on Starbucks and Dunkin' Donuts, but I'm sorry.
Pick on them.
That's where I hit the first one. Starbucks, Dunkin' Donuts, stop your runs, when you're pumping gas into your car, like don't run into Wawa and get your soda and a donut or whatever it is.
Or don't take that drive to 7-Eleven or the market, and it's a couple of 5 or 6 blocks down the road. Might have to take that walk.
And we can make our own meals. We can eat in the house and teach our kids how to cook and make it a family project, And so there's a lot of ways that we can pull back without suffering, and, so that we have the money for our mortgage, for our car payment, for if gas costs more. Not that we want to spend our money on higher gas prices, but when we have to, we can trim back somewhere else and be a homeowner, because every payment that you make every month, you're putting a deposit into the equity bucket, and that equity grows. You also get appreciation, price appreciation. When you upgrade the house, you get even more appreciation. So that's a big savings account mostly for people's retirements. So it's a great thing to do.
And the home actually can be a hedge against this inflation as well, because one of the things that's happening right now, that prices continuously go up. So when you buy, you're buying ahead of the market, and the person next, even the folks behind you are still getting deals and basically putting ahead of the hedge a little bit of that inflation, because I mean you're getting in, prices continue to rise, and then the fact that most people are not even paying attention to is that, and I had this conversation today with a prospective tenant where we were talking about the rents. If the landlords actually increase their rent every year by 10%, if you're in a home and it's $2,000, or let's say $1,000, and they do 10%, that's an increase of $100 next year that you wasn't expecting to pay, right? If you purchased a home, you're not going to get that same hit. And here's the other thing I think folks need to have an understanding on, is that we look at a mortgage payment, and we know that the lenders and everybody put together that it's the payment and escrow, right? So we call that the payment. But really, if you really want to narrow it down and look at it, your payment to the principal never changed. Your escrow did, right? And so that's the thing that I think people really need to understand. If you think that, or somebody said, but they lied to you, that my payment changed, no, escrow changed, which which is the taxes, your insurance, the homeowners insurance, those things went up like everything else went up. Your principal fixed payment did not change at all.
Yeah, principal and interest on a 30-year fix or a 20-year fix or a 15-year fix is exactly the same every month. It does not change. It cannot change by law. It will not change. So you're really fixing in that housing payment and stabilizing your budget. And then just think of all the great things that happen when you own a home. Like, it stabilizes the whole community. You have neighbors, your kids have friends, you're going to the local school, so many activities take place. And every month you're building equity in your house. Even if the house prices stabilized and started being flat, you're still building equity, because every month a chunk of your payment goes to the principal, and you're paying that principal down every single month.
And it's historic that your house appreciates at least 3% a year. So
because 1960, there's only been a couple pullbacks, and they're very short-lived. Maybe a year, even if it's 2 years, but then it starts creeping up again. And it was a bit of a time after this huge crash, which was the worst recession that we've had since the Great Depression. And that, even after that, it was only a couple years until prices started going up again, because people want to own, because owning it's a psychological advantage. It's emotional. It's about your family. It builds equity, which is money for your future. It's a great thing to do. And so it's part investment, but it's investment in your family and in your finances.
And it's a total peace of mind with a lot of other things that could come. I'm gonna add this one thing in there that I've actually been thinking about, to go back to some people that have owned their homes for 15 years or so, and maybe even be empty nesters. Let's say you're in a 3-bedroom split level, or any 3-bedroom home that has a lower level, that maybe even have, or 4-bedroom that has a lower level. If you're not using that whole lower level, if a 1-bedroom today is $1,000 and you have a 1-bedroom at lower level, you can come up with an idea to put an extra $1,000 back in your pocket by subdividing that one area off and renting that area out. And let's say you've been in that place for 15 years, you refinance, and your mortgage payment is only $1,000 a month. But you just figured out a way to put $1,000 back in your pocket. But you can't legally do that when you're renting and you're using somebody else's place, and that's what they're actually, that's what their goal is, to get your money to pay off where they are. So it's a lot of things when you're own your own home, that you can do, especially if you think about it down the road, the kids leave out. Yeah, again, you got 4 bedroom, rent the lower level out, rent a room in the other area of the home.
Yeah, I have a customer who's a young woman. She owns a house in Northern Virginia, and she has an area, that's off separate, and she rents it out Airbnb and covers her mortgage every month. She doesn't have a mortgage now. She has it, but it's covered.
Yeah, so the other thing with home buying, we have to think about how we can remove having to have these. Robert Kiyosaki and his wife said it good in the book, where Kim wanted to actually go buy a Mercedes, right? And then what did she do? She didn't come to her husband and just say, "Hey, I want to buy a Mercedes." She had a plan. She went out and bought a house that actually, after the rent was paid, it was enough left over to pay for the Mercedes. But it's the same thing you can do. Although we don't call the home you live in an asset, but you can turn it into one. Because once you have all that space, I'm going to talk to the ladies real quick. You got all the clothes in the closets and all the rooms and stuff. And I know you don't want to share it with them, but there's $1,000 a month, $600 to $1,000 a month easy sitting in a room somewhere.
Yeah, and also you can use that if you have, and this has not been popular in America for a long time, but historically, multi-generational families, and you have areas, you put a little kitchen downstairs, and you have, you're the same family, but you're now have 2 groups paying for the one mortgage. So it doesn't even have to be a stranger. It can be a family member. And, so then you're not really living with somebody you don't know. But or like you said, if you can separate off a whole area and rent it as an apartment, then it's not so bad.
Yeah, you take a split level. Some of them have the garage or whatever. Get a door put in down there. You separate this thing over, and say you don't use the garage, turn the garage into a room. I've seen that done through the years as well.
And yeah, because during tough times, maybe you only do it for a couple years if that's what you need to do.
When I was 18, when I first moved out, the first apartment I looked at was some folks that had a split level. They took the lower level, turned it into a 1-bedroom apartment. You come in and out through the back, and you can also you do off-street parking. But the little space had everything on the lower level. The young couple just had a baby, but they were looking at another way to offset because mom's new mom was not working at the time. So
it can be done. Where there's a will, there's a way.
That's the thing. That's the thing. So looks like we about to wrap it up unless you have anything else. If you don't have anything else, just tell the people how to reach you.
Well, I first suggest that it's a great time to buy. Marcellus always has great insight for his buyers, and I always appreciate talking to him because he always brings a new nugget in that adds some real value. So thank you for having me on, Marcellus. I'm Laura.fournier. I'm with Nations Lending. We are a nationwide lender, and I'm licensed in Maryland, DC, and Virginia. And I love to help first-time home buyers and move-up buyers with some more complex ideas on how to finance that move. And I can be reached at 301-674-7716.
That big
301-674-7716.
On that big billboard
yeah,
behind
you
us.
See it on the billboard behind me. So, and I'm happy to address questions, concerns. I'm always going to give you all the information about your mortgage options. I put it in writing. You're going to see all the expenses over the 30 years of the loan, all the communication, education, and information you need to make a great decision. And I'll be there the whole time with my team helping you get through the process. So,
Laura, I appreciate you.
Go for it. Don't give up on your dream of home ownership. Go for it.
Thanks a bunch, Laura. Hey, this is Marcellus Kendell and Hump. I don't even know what they Hump Day Real Estate with Kendell. Talk to you soon.
Great, thank you.